For nearly 2 years, the world is trying to live with the COVID-19 pandemic. We're still at the worst of the medical emergency, with an immense impact on the economy. Across Africa, the pandemic is expected to push 40 million people into extreme poverty. Debt burdens are likely to rise by 10 to 15% points in the short to medium term. Business as usual is not an option.
Africa will need an additional $425 billion in external funding between now and 2025 to fully recover from the pandemic. Economic governance and creativity have to be part of the financing solution.
So increasingly, Africa is looking to capital market as a source of financing. And this is really the new way in terms of how the financing structure or landscape of Africa is going to look like going forward.
To succeed, African countries need to think whole. Improving domestic revenue mobilization, transparency and accountability, and public finance management, and overall macroeconomic policy governance will go a long way to improve the financing for development in Africa.
It is time to find innovative solutions to sustain growth, to rethink development financing models, to strengthen regional and continental integration. Welcome to Cabo Verde. Welcome to the African Economic Conference, where the bold discussions will be held to finance Africa's post-COVID-19 development. How should Africa prepare for post-COVID-19 recovery and transition? Do African countries' financial systems fit the reality? Why have decades of spending had such a small impact on improving the lives of the poor? What would be the next normal for digital transformation after COVID-19? Jointly organized by the United Nations Development Programme, United Nations Economic Commission for Africa, and the African Development Bank Group, the conference calls for a radically new approach. A platform to take new ideas on board, to bring positive transformation, to find new solutions and meet the Sustainable Development Goals by 2030, to rethink our economies and redesign our future. Because now more than ever, it is possible to think about change, to foster innovation, to build Africa one idea at a time.
Good morning, everyone. Thank you very much for joining this session. My name is Dr. Hanan Morsi. I'm the Director of Macroeconomic Policy and Research at the African Development Bank, and I'm moderating this session. Just wanted to make sure that we have all the panelists before we start. If the team can confirm.
Yes, we're both here. Thank you.
Great, thank you. On behalf of the Africa Economic Conference organizing partners, I would like to thank all the panelists for accepting to participate in today's session to discuss a very important and timely issue facing many of the African countries regarding sovereign debt. I'm sure that we will greatly benefit from the panelists and their insights and vast expertise on this topic. And we will really gain new perspectives and ideas for implementable solutions and innovative ways to deal with this challenge. The theme of this plenary session is a thought-provoking one, which is Africa on the verge of a new debt crisis? Of course, this is a legitimate question to ask, given what we have witnessed during this COVID-19 pandemic. We have seen the debt level rise in many African countries. The African Development Bank estimate that the average debt to GDP ratio has increased by 10 percentage points in 2020, and the debt to GDP ratio could rise further to reach 75% by the end of 2021, compared to the pre-pandemic level where the debt to GDP ratio stabilized at 60%. Not surprisingly, the situation has exacerbated Africa's financing needs. The African Development Bank estimates that African governments require additional gross financing of about 484 billion US dollars within the next 3 years to close the financing gaps that is necessary to respond to the needs of the recovery from COVID-19. And of course, all this could further exacerbate the pressure on debt. We also have seen the deterioration in the debt sustainability ratings of countries. For instance, the debt sustainability analysis for African countries, we see that out of the 38 countries for which DSA is available, 15 countries are already at high risk of debt distress, 6 are already in debt distress, and 17 countries have a moderate risk of debt distress. And there are no countries that is classified as debt distress. We have also witnessed that countries are becoming increasingly unable to repay their debt service. So when Zambia announced its first pandemic-induced debt default in the continent, there were a lot of concerns and fears whether more countries would be vulnerable to debt distress and defaults. This have triggered, reminders of episodes that happened before, basically concerns on whether the continent will be facing another era of debt crisis as it had witnessed in the 1990s. And we have seen some initiatives trying to help African countries deal with the economic fallout of the pandemic. For example, there is the G20 debt service suspension initiative, which aims at helping countries concentrate the resources on fighting the pandemic and safeguarding lives and livelihoods of millions of the most vulnerable people by suspending debt service payments for the poorest countries. Already it has provided some temporary relief for over 40 eligible countries, African countries, with a combined 10 billion US dollars in due debt service obligations suspended between January to September 2021. There is also some hope with the new G20 and Paris Club Common Framework for Debt Treatment beyond the debt service suspension initiative, because it aims to broaden the scope of that initiative by including not only members of the Paris Club, but also non-Paris Club and private creditors. The question then is, should these initiatives be the way to go for Africa debt problem? Are there any better solutions to handle this problem and the root cause of it? What should be the role of the private sector and other domestic actors in supporting of financing development needs? And I'm really glad that we have today distinguished panel with very knowledgeable experts to respond to these questions and many other that our participants, either online or physically, will ask. I would also like to remind all virtual participants that they can ask their questions the online chat platform, and our panelists will be happy to respond to them within the time limit of that session. This session is about 1 hour, so to make the most out of that session, we would greatly appreciate to have a concise questions to allow panelists to respond accordingly and to accommodate as many as possible from the participants' questions. So let me start by the leading participants in our panel, Ms. Mavis Wusu-Gamti, who is the Executive Vice President of the African Center for Economic Transformation. Your institution calls for a new approach to ensure that African countries fundamentally reorient their economic and fundamentally reorient themselves and realize economic transformation. So do you think that if African countries find themselves in the current situation, it's primarily due that they didn't or they're not doing enough to transform their economies? And in other words, are the African resources invested strategically to avoid the trap? To you, Ms. Mavis.
Thank you very much, Hanan. And I'd like to take this opportunity to thank the organizers for inviting me to join this panel. So at the African Center for Economic Transformation, we define economic transformation as growth with depth. So the kind of growth that enables economies to diversify the basis of their economic growth, that enables them to diversify their export and increase their export promotion, that enables them to enhance productivity within their economies, ensures that they are using their technologies effectively to grow their economies. But all of this should contribute to the human well-being, to ensure that human beings are actually benefiting from growth on the continent. And I'm rather sad to announce that from the early data from the Asset Africa Transformation Index that we will be publishing in 2022, the early data shows that transformation on the continent has been poor in recent years. So even pre-COVID, we were not transforming at the pace and rate we needed to transform at to enable us to ensure that we are growing in a way that enables us to better withstand external shocks, enable us to recover from the kind of crisis we are going in at the pace that we need to recover from. So, in fact, in a number of the countries that we are looking at the data, between 2015 and 2018, we are seeing that transformation was going backwards rather than forward. So it wasn't looking good for us before COVID. But your second question was around debt. And the question is, was our debt being used effectively to transform our economy? And this is an ongoing contentious point. You know, to what extent is the money that countries are borrowing serving the priorities of the government in power rather than serving the citizens? And to what extent are they being spent on issues that will enable us to pay them back over time effectively? The truth is, when you look at the numbers, generally African countries have not entirely invested their debt strategically to avoid the debt trap. So borrowed funds to date has been spent mostly to plug fiscal deficits, often caused by adverse exogenous shocks such as falling commodity prices or civil conflict. We are also seeing that borrowed funds are being spent on massive infrastructure projects. And unfortunately, we are also seeing borrowed funds lost to fraud and corruption. So let me start with financing fiscal deficits. The recent rapid growth of debt that we are seeing on the continent was largely driven by deteriorating fiscal positions of many African countries, especially resource-rich countries who took a hit following the commodity bust between 2014 and 2015. So countries' revenues fell and their fiscal deficit widened. So governments were required to borrow to be able to finance projects. Now, this challenge has been compounded by the fact that our population is growing, so we need to spend more money on our social and healthcare to address the needs of this growing population. You know, in a large number of our countries, the funds that were borrowed were channeled to recurrent expenditures such as public sector wages. So virtually all the Euro bonds that were issued over the past 3 years were spent on non-productive short-term recurring expenditure and the repayment of maturing bonds. So we see that the recent Euro bonds that were issued by Benin, Cote d'Ivoire, Kenya, Morocco, Gabon, Ghana, Egypt were all used to support budget deficit and bond refinancing. And unfortunately, we are also having to spend borrowing to contain the rising conflict and terrorism in some parts of the continent, such as the Sahel. So that is the first area where we are spending money. The second area where we are spending money is actually on ambitious infrastructure projects. Now, this should be a good thing, right? Because infrastructure is supposed to generate return on investment. The problem is that most of the debt instruments that we are employing to finance these infrastructure projects, such as Eurobonds, are short to medium term in duration. Yet infrastructure is long-term finance project. So we are using short-term debt to pay for long-term bonds and long-term investments. The second thing is the quality of the investments we are doing, the inefficiency of how we are implementing these projects is also costing us money. Poor governance challenges are cropping up in our ambitious projects. So they are not able to pay for themselves. For example, Ethiopia's 10 mega failed sugar project, Kenya's Mombasa-Nairobi standard gauge railway project. We are not therefore getting value for money. If we could improve efficiency in debt financing of infrastructure, then we would see better return on investment. And finally, unfortunately, we are seeing the money we are borrowing being lost to unreported or corrupted expenditure. So the World Bank recently found that aid disbursements or debt disbursements to highly aid-dependent countries coincide with sharp increases in bank deposits in offshore financial centers known for bank secrecy and private wealth management. This is not how if our debt is spent this way, then our return on investment is not going to be robust. And we've seen examples of this in Mozambique, in Gambia, in Congo, you know, just to name a few examples of where serious governance issues and embezzlement of debt funds have contributed to the surge in public debt. That's everything. Thank you.
Thank you very much. I think there are many takeaways from what you've mentioned. I think you've emphasized the need for the African countries to diversify, increase their exports, enhance their productivity, and the lack of economic transformation that we have seen even before the crisis. And this is becoming even more urgent with the pandemic as to enable countries to recover and grow. That basically we've seen the continent basically going backward rather than forward in transformation, and highlighted the issue that the borrowing, what the borrowing is being used for, that it's basically mostly channeled to a non-productive and current expenditures, and then for those that are actually channeled to investments, that we see this maturity mismatch between the borrowing, which is on short term, that's being borrowed to address long-term projects. And we also see issues of efficiency and governance that really impact the returns on these investments. Thank you very much for your intervention. I'm now turning to Mr. Jason Rosario Braganza, the Executive Director of the African Forum and Network on Debt and Development. The mission of your institution is to influence policy towards prudent debt management and sustainable development. So from your perspective, do you think that the lack of clear policies on debt management is the leading cause of Africa's debt crisis? We've all heard of the news about hidden debt scandal in some countries where billions of dollars went missing. What do you think really went wrong in terms of the management of African debt that could have prevented problems that many countries are facing? To you.
Thank you very much, Hanan, for that question. And I just want to, first of all, extend a big thank you to UNECA, UNDP, and the African Development Bank Group, and the people of Cabo Verde for hosting us over these past few days. It's been a fantastic experience. Despite the journey to get here, we've really enjoyed the hospitality. To get to the question, I think the starting point to look at this is where countries are still at following the HIPC and MDRI 2000 debt cancellation movement. Many countries that qualified for the completion point were left with very vulnerable and fiscal systems that were not able to cope with the additional fiscal space that was created as a result of the debt cancellation. And the second point was to look at how the economic structure of many African countries and economies were at the time of this completion point when the debt cancellations were approved. And what I mean by this is the system itself on the continent was not ready to deal with that sort of space. We had not transformed our economies, as Mavis has said, sufficiently enough. And there were already systemic and existing challenges, both of the economic and the social kind, that many African economies needed to deal with and address during that time. And so it's no surprise when you look at many African countries today, vis-a-vis where they were during the HIPC and MDRI completion points, many of these countries are back to where they were in the early 2000s. The third point that we have seen or we have observed is that the gradual decline in the emphasis on internally generated revenues or domestic resource revenue mobilization in favor for externalization of the financial needs has meant that the kind of policy advice that has been given is to encourage borrowing in order to generate domestic revenue mobilization. And when you do not have systems in place or revenue mobilization that is aligned or growing at the same pace at which you can borrow, this has led to vulnerabilities and risks for many African governments and economies as a result of as a result of shocks that we are facing. The fourth point is to look at how, and this is a point I've been trying to make throughout the conference, is whether the economic, financial, trade architecture in its current form, with its current political and economic ideology and philosophy, is relevant or is still fit for purpose for Africa's transformation. The entire week we have been talking about leveraging private finance, leveraging different types of financial instruments. And a lot of these instruments are about externalizing the financial burden or the financial resource mobilization of African countries in the form of debt. And yet we do not have the infrastructure in terms of policies, in terms of legal frameworks to sustain and to protect African governments should there be shocks and crises that come in. So, and lastly, in terms of where we are, in terms of how debt management and debt financing is managed, a lot of it is still being managed and driven outside of the continent. The rules are being set by global financial creditors whose primary aim is to make a profit at the expense of African economies. And as Mavis was saying, the direction and the motivation around borrowing is for short-term needs, for fiscal deficit financing, as opposed to looking at the more broader development of our economies. So I do think that in terms of the policy framework, the legal framework, and the architectural framework within which debt financing is discussed is really still very much externalized from the continent, with rules, regulations, and the entire design of financial instruments and debt instruments being done by not those on the continent, but those external to the continent, with the primary aim, in my opinion, and many of us in civil society, with the primary aim of benefiting the benefactors in the private sector and in the financial sector, as opposed to supporting genuine domestic resource mobilization. And so that's what we've seen as the risks and the challenges in trying to manage debt prudently, because the rules are set outside and then imposed as part of the conditions and as part of the requirements for many of the African governments to go and negotiate. And I think lastly, as I wrap up, I've got 2 minutes. I think it's important also to use the opportunity that COVID-19 is presenting to rethink how the debt financing model for Africa should look. We shouldn't necessarily try and expect or assume different outcomes from the same architecture. We have seen time and again that the current global architecture for finance, for trade, for commerce has within itself inbuilt vulnerabilities. And so if we are assuming to expect a different outcome for Africa's transformation in this architecture, I think, in my opinion, in the next 10 years or during the next in the next crisis, we're going to be further off as a continent and still trying to play catch up. So we do need to use this opportunity of COVID-19 to build forward together with a different philosophy, with a different ideology, and one with an architecture that fits our continent's context, as opposed to trying to fit our transformation in a system that has its own vulnerabilities. Thank you.
Thank you very much for the points that you've made, and I noted that you highlighted the gradual and continued decline and emphasis on resource mobilization, the issues of the need, and you iterated this number of times, the need for an overhaul or reform for the international and global debt architecture and debt resolution architecture that takes into account really the interests of both sides, not just only the emphasis on creditors, but also that of debtors. So I think these are all very interesting points that I think also other panelists would feed into this discussion and views on how we go from there. Let me now move to our panelist has been changed from what we had in the agenda. We have now Dr. Raymond Gilbin, Chief Strategy Analysis and Research Team at UNDP. And we all know that UNDP is engaged in helping African countries to meet the Sustainable Development Goals. High levels of debt have been considered a key obstacle to the Sustainable Development Goals. So what do you think are the good alternatives to debt financing Africa's development and therefore achieving Sustainable Development Goals? To you.
Thank you very much, Madam Moderator, and thanks to all of you for joining us. I think this is one of the nagging issues that we've been trying to contend with for the longest time. I have 4 quick points to make that will speak about where we are now with debt, how we should think differently about debt from a development financing context, and what are some of the alternatives. And I'm sure we'll have time to discuss. A couple of recent articles have talked about something called pandemic debt, which is debt over and beyond what had been anticipated for for countries across the world. In Africa, we see an increase in pandemic debt, almost 4.5% increase in pandemic debt, meaning that because of the pandemic, African countries have had to contract additional amounts of debt. Normally we think debt, we think external, but the untold story is that domestic bond issuances in Africa in 2019, $34 billion, 2020, $73 billion, more than double the amount. So the stresses are not just to do with what Africa owes the rest of the world or is paying the rest of the world, but what African governments owe to their people. And when you think about debt financing, the challenge is how do you address those particular stressors without destabilizing the macroeconomic fundamentals? Third point is both external debt. I talked about pandemic debt, which is increasing, and it increased a lot more for the already debt-stressed countries. Both pandemic debt and domestic debt are posing this problem. We have a number of initiatives worldwide, the DSSI, the CCRT, the AFDB's COVID response facility. All of these are great initiatives, but they deal more with the liquidity side of the debt crisis than the stock side of the debt crisis. And if we're not addressing the stock side of the debt crisis, the debt servicing requirements will always be there to crowd out other essential spending. So the development context here is, how do we create true fiscal space? How do we understand debt sustainability in a way that makes sense in a development context in Africa? Which is why I believe that in addition to initiatives that either postpone debt repayment or forgive interest payments, we should be thinking fundamentally about how we stop the stock of debt from growing. We're seeing, I think, initial calculations were that the stock of debt in Africa would grow at about 6% a year. The additional 4.5% pandemic debt premium means that it's been growing at over 10% a year, the stock, because of COVID. And we also know that many African countries are going to take about more than 2 to 3 years to recover from the financial and economic impacts of COVID. So the numbers are not adding up. It means that this fiscal stress will be carried over more than a decade, probably, if we don't do something about the stock. And this is where we need bolder and a lot more comprehensive plans. In the late 90s, I was at the African Development Bank and I worked on the HIPIC initiative. Back then, the major challenge was multilateral and bilateral debt. Commercial debt was there, but not that much of a problem. Even though it was not that much of a problem, what happened was the moment we had relief on bilateral and multilateral debt, vulture funds, financial institutions, started buying and selling African debt on the on international stock markets and making a killing. Buying the debt for at times 2 to 3 cents a dollar, and then adjudicating in court and getting judgments for full value of the debt. So we need a global response, not just to address that particular type of what I will call contamination in the debt instrument, in the debt in the debt calculus, but also to recognize that short-term relief on debt payments are not the same as helping Africa trade its way out of debt. So as we think about regional solutions, have to think about how regional trade could allow African countries to do much more, and how we ensure that we are not just postponing a resolution to the problem, but we're taking resolute action today to enable us to be able to ensure that African countries don't just have temporary fiscal space, but they have development financing options that are relevant, that are sustainable, and that actually supports development. Thank you so much, moderator.
Thank you. Thank you for highlighting these points. I think you've stressed the need to really address the root cause of that challenge without destabilizing macroeconomic fundamentals. You highlighted the role for regional trade and also the evolution of debt and how also even the impact of the domestic financing mean for development. Thank you. I will now like to conclude this first round of questions with my question to Dr. Falilou Fall, who is the Deputy Head of Division of Country Studies, Department of Economics at OECD. Developed countries are one of the most important lenders to African countries. So from the perspective of OECD, are debt risks critical for Africa in post-COVID era? Which particular debt risk should African countries be more worried about post-COVID? And what is the role of the international community to address these issues? Thank you. To you.
Thank you, Mrs. Morsi, and thank you to the organizer, the three institutions, for the invitation. I think before getting to the main risk, I'd like to highlight 2-3 points. One point is the accumulation of productive capital. If you compare the accumulation of productive capital with the accumulation of debt, you will see that there is a huge difference. The highest stock of physical capital is like Nigeria, 700 billion, Algeria, 400 billion, and South Africa, 300, almost 400 billion. Algeria and Nigeria are two resource countries. And for all the rest, it goes from 2, 3, 4 billion capital accumulation. And when you compare it with the debt accumulation, you wonder where the borrowing went. And I think that is explaining we don't have the growth rate we need to sustain the debt. Because always we talked about the debt ratio and we tend to forget the denominator. If we have enough growth, our level of debt would not be an issue. It is an issue because we don't have enough growth, and it is an issue also because fiscal resources are low. People complain and say we should do more fiscal mobilization. One has to acknowledge that if people are poor, you can't mobilize more. You can, strengthen your system, you can try to do, but there is not much to catch. There is part of the population where you can increase your fiscal mobilization, but in 80 or 90% of the population, there is not much to take. So we need to remind us that. So now turning to the risk, I see many risks, but I think the main risk we are facing is, and as Raymond said, we'll be reaching 75–70% of debt level. The capacity to borrow for the next 10 years has vanished. we will not, African countries will not be able to borrow in the next 10 years as much they borrowed in the past 10 years. Because they've reached, if the debt stock is not treated. If the debt stock is treated, then maybe we'll see another round of debt accumulation. But if the debt stock is not treated, then we have reached the limit for many countries in terms of debtor borrowing and debt servicing. And that raises a lot of issues because the needs are there and they are very important. So it opens the question of the financing of our economies and infrastructure. The other risk beyond this, I think, will be, and it is one of the main risks we will be facing, is the refinancing, the rollover of the debt. Even if they can't borrow more, there will be this need of refinancing the debt, the rollover of the debt. And we've seen already some tensions in terms of refinancing debt denominated in foreign currency. And as rates will be increasing in advanced countries, so the attractiveness of Africa may decrease. Africa has been very attractive in the last 10 years because there was no yield in advanced countries. So there was a run-to yield that made Africa attractive. And now what we will see is that Africa is losing this attractiveness in terms of return because rates will be increasing in the US and in the other countries. And that can make that there is a risk in the rollover of the debt. So what are the solutions and what advanced countries can do? I think as it was mentioned, there is this short-run support that was provided by the G20 and advanced countries. One of the main tools we have now is this SDR allocation. There, it was done in a way that everyone gets related to its share in the IMF. So Africa is only having 33 billion out of 650 billion. But there is a commitment in the G20 responding to the request from African Union and African presidents to have a reallocation of advanced countries' share up to 70 billion. So those 70 billion, and I think Europe and Africa, you'll have the summit by 18th of February, and there will be announcement and commitment to reallocate part of the allocation to African countries so that Africa will receive around 100 billion of this SDR. So there is a debate on the use of this. We see central bankers saying, oh, this is foreign currency reserve. It should go to the central bank. We've seen multilateral development banks asking to receive this allocation so that they can leverage it and finance the economies. And we have governments that obviously, given the debt situation, would like to have part of it. And I think there need to be a sharing rules between those three objectives, which are different, but which are important in their own. And I think the treatment of the debt stock should be part of this use of this SDR allocation so that we lift a little bit the situation for governments. And to finalize, the last point is the financing of our economies. As it has been mentioned, debt cannot be the only way of financing the economy. Some people are expecting FDI and foreign direct investment funds to invest and finance the economy. Africa is only attracting now 2% of the investment fund industry. So one can see it positively and say, okay, there is a room to increase it. But as a matter of fact, those investment funds are looking for big projects, while the bulk of the need is for smaller projects. So we still need a mechanism to channel money to the economy locally. And I think there are many things one can do on that. The cost of capital is too high, and the cost for capital for the banking system is too high, and regulations that have been put in place in advanced countries have been dumped into African countries without, I think, a proper tailoring to the countries, making the financing mechanism too costly for the country. I'll stop there. Thank you.
Thank you for your intervention, and I think I noted a number of what you've said, including the issue that there is a risk that the ability of African countries to borrow will actually be limited going forward, given the current stock level of debt, and the issue of refinancing risks and the cost of capital remaining high. So all these points are noted. Thank you all panelists for your insightful responses. Now I would like us to discuss more on the different initiatives we have recently observed since the start of the pandemic, like the G20 Debt Service Suspension Initiative, or the new G20 and Paris Club Common Framework for Debt Treatment beyond the Debt Service Suspension Initiative. We also heard many countries, leaders calling for debt relief for the continent. So what do you think about these initiatives? Is that a long-term sustainable solution? Africa's debt crisis and concerns on debt vulnerabilities. What more need to be done, not only by African countries, but also by their lenders, either bilateral, multilateral, or even commercial? I'd like each of you to give your own perspective in no more than 3 minutes. And I will start in the same order we've been through. So I'll start with Ms. Mavis, Usumu and Gimafi. If you can please give us your perspective.
Thank you very much, Hanan. So in terms of the initiatives that have been proposed, we are on the right track. So the DSSI, having it extended by another couple of years will become critical. But during those 2 years, also thinking through how do you phase payments? Because what we don't want is to come to the end of the 2 years and then countries are suddenly hit with massive bills. They just can't afford it. So we've also got to think through phasing of that time frame. On the G20 initiative, it's excellent that China is part of the framework, but it would be helpful to articulate exactly what China's role is. And we've also got to have a frank conversation, as one of the panelists said, about how do we bring private sector to the table. We saw in the past that it's been made illegal for a number of private sector companies to buy African debt and retrade it on the market. But that was at that time. What are the frameworks for going forward? Because on current trajectory, private companies are just going to free ride on whatever debt structures countries come up with. So we've got to find a more robust way of bringing them within the frame. And I hate to say this, but we are going to have to think of some kind of debt forgiveness for the continent yet again. But that debt commitment has to come with some very clear conditions around robust fiscal management. There has to be some systems in place around how we manage our own budgets, how we manage our own fiscal frameworks, and how we run our economies. And I hear the argument around the difficulty of tax revenue. But let's be honest, if we tried to get back and block some basic systems in place, block the kind of capital flight that we are seeing from our countries, we could find a lot of savings that would contribute to our revenues. We also have a lot of agreements with corporates around tax holidays that we could do a lot more around to get revenues back to our economies. So there are elements on our side that we can do, but globally, there are also frameworks that needs to be done. And just finally, we need a much better framework in place around ratings. We need some kind of quasi public rating agencies so that the cost of borrowing for our countries are not as unfairly high as they currently are. That will be my point. Thank you.
Thank you very much. Mr. Jason Braganza, up to you, the same question.
Please, Jason, just hold on 1 minute. I have an urgent announcement to do. Those who have to do the PCR test, they have to go now in the clinic room, because these people have to leave to process the test and give back the results. So if you haven't done it yet, please go now to do it. Thank you. Madam Moderator, we have the Q&A session and there are many people in the room. Thank you. Over to you.
Yes,
okay.
By the panelists answering the same question, and then we can move to the Q&A. Thank you.
Okay, thank you very much. I think let me start with the question around the DSSI and the G20's common framework. I think it's widely acknowledged that both initiatives, the speed at which they were initiated and introduced was very much welcome initially to deal with the immediate shocks that came with COVID-19 a few years ago. Now, the challenge we're now facing with the DSSI is that it is coming to an end at the end of this year. And, you know, it was, as the name says, there's a famous adage, it does what it says on the tin. It suspended debt servicing. It did not remove it. It did not cancel it. So the servicing of the debt of many developing countries, in particular on the continent, is going to resume at the beginning of 2022. Now, the manner in which this is going to unfold, I think Mavis has touched on this, and there's been a lot of analysis on the kind of figures and the kind of fiscal impact that this is going to have on many African countries that have seen their tax revenues dwindle and shrink, you know, during the period of COVID-19. So there is definitely a need for a thinking of how we sequence the DSSI over a slightly longer period of time and cushion many African countries from the impact of suddenly having to resume debt repayments. Because as Dr. Falilu has said, if you all of a sudden create the area or the potential for debt to be serviced, we are going to see a lot of the SDRs being redirected there. And the intended purpose of why those SDRs were issued in the first place would be absorbed and would be negated. And therefore, you know, that opportunity with the fiscal space that was being created would be lost. On the G20's common framework, I think, and we as civil society organizations have said, it is a very weak system. It is a weak framework that does not address the very diverse creditor setup that many African countries are faced with. The dominant players in the debt that African governments have accumulated are not part of the G20's common framework. They're not even considering being part of the discussions. And it's no wonder only 3 countries have signed up to this. And I think we need to be honest and ask ourselves, you know, is this really the correct initiative or the correct framework to get African countries out of this? We've got Chad, Zambia, and Ethiopia. And immediately, I think Mavis has talked about the role of credit rating agencies, how they are playing such a destructive role in trying to get a comprehensive, genuine common framework to take place. And I think lastly, what we need to start hopefully thinking about moving forward is dealing with also leakages. The entire week we've talked about mobilizing and leveraging private finance and alternative forms of finance, but we've spent very little time at the technical level in terms of the research papers talking about issues of illicit financial flows and dealing with that major elephant in the room that also, many institutions in somewhat way inevitably play a role in facilitating illicit financial flows. The figures are roughly 80 billion, according to the ECA, a year lost to illicit financial flows from the continent. So I do think we need to think through around those architectural issues yet again, if we're going to genuinely come out of this. So I'll stop there for now. Thank you.
Thank you. Mr. Raymond Gelden, if you can give us your insights on the same question.
Thank you so much. I'll be very brief. What do we need to do? Someone once said that those who don't learn from history are condemned to repeat the mistakes. In 2000, when we had the HIPIC initiative, there were two important criteria: the fiscal criterion and the export criterion. The export criterion was very, very sensitive to volatility in commodity prices, meaning Africa's trade is what made the first country to reach the decision point in 2000, they reached the decision point in 1998, was Uganda. Within a few months, they went from sustainable to unsustainable. Why? Commodity price fluctuation. And then we had enhanced HIPIC, then the MDRI, all dealing with the debt service liquidity issue and not the ability to pay. If there's one thing that must be done, it's to help Africa be grounded, not just in trade, but also to re-engineer global and regional value chains for Africa's products so there's more value added in the economies so they could afford to pay. Africa does not have a choice right now because the infrastructure gaps, the energy gaps, the healthcare gaps, the education gaps, you can go on, are there. And they need to be financed so that African countries will get up to and remain at that level. The focus of this year's AEC has been rethinking, reimagining development finance. One reason why African countries default to debt is because there are not many other financing options that are available to them. So one, we need to work on the ability of African countries to pay because there's lots of something to pay for. Secondly, we need to ensure that debt is not the only option. There can be equity options. There can be public-private partnership options for most of the long-term financing needs. And so those are two things I would leave with you. Thank you so much, moderator.
Thank you. And finally, Mr. Ford.
Thank you. 3 points. The first point about this management of this debt and the debt relief. China is playing a big role because you know that China and the private sector, it's more or less 50% of the debt. So you can't ask advanced countries to pay back the debt African countries own to China. You know, it's very hard for any leader in Europe or in advanced countries to come to this public opinion and say, oh, we are going to give money to Africa so that they pay China. That doesn't work. So China has to be part of the solution. And I remember I was already in government institution, and we were discussing in 2011, 2010, and African countries saying, oh, now we have options. It's not you, advanced countries. You don't want, you have conditionalities. We are going to China without conditionalities. So now it's very hard to make the case because some of the borrowings we are made in a very unresponsible way. So China has to be part of the solution, and lessons have to be drawn on this situation from the African countries' side on this debt, the borrowings. Second point, let me turn to the spending side. We are not discussing the spending side, but there is room to have savings on and efficiency on the spending side. Just give you one example I know very well. The government wage bill for South Africa is 14% of GDP. It's almost 40% of government spending. Even wage has been increasing above inflation in the last 10 years by 2 percentage points per year, while productivity was going down. That's a trend unsustainable for any firm. You go bankrupt. And in many of our countries, the government wage bill is high. Also, the spending efficiency is one of our big problems, because if you build an infrastructure where the real cost is 10, but it's billed to the government 100, then we have issues. And those are also things we need to fix. Finally, my third point on, I think we are lacking the proper discussion on mobilizing central bank money to channel it in the right way to finance our long-term needs. The needs are so huge. I don't believe we will get this financing, even if we combine all external sources, private equity, private financing, debt, and etc., that it will finance our needs. Or it will take 100 years to do all we want to do in terms of road, railways, water, electricity, housing, urbanization, and etc., and etc. So we need to think in a strategic way to mobilize those things. We can discuss what's happening with, if we take the central bank and the management in the CFA zone, where all the strategy is how we define the stability of the currency. But is the stability of the currency a state per se? I'm not saying we want, huge volatility of the currency, but there should be a trade-off between the stability and the financing and the dynamism of the economy. I'll stop there. Thank you.
Thank you. Thank you very much for all the panelists for their insights. Let's take 2 to 3 questions, given the time. We start by the floor so that we give the audience the opportunity to ask panelists questions. Please go ahead.
Yes, we have several hands, and I will ask people to be very brief, very short, because we are getting a run over the time. So Mr. Ali Zafar over there first, then I go to Palani second, and then 3 to the man behind here, and then 4 to Hervé Kuraogo. So go ahead.
Okay, thank you very much. I'll be very brief. We tend to treat African governments as homogeneous, but it's a continent of wide variety of macroeconomic management governance. So what I'm wondering in this debate is, what is the panel's view on the differences between governments? Shouldn't there be more carrot for good performing governments and more stick for bad performing governments? Why should governments that have mismanaged resources free ride and get debt relief while really good performers are doing the hard work? Thank you so much.
Thank you for an interesting presentation by all the panel members. I have just 3 quick points. First one is actually the recent debt dynamics in Africa, a little bit worrisome. for the following reason. First, I mean, Raymond's highlighted that there is actually, if you look into the debt decomposition, there is a huge shift from external sources to the domestic sources in the debt financing source. That itself worrisome, because when you government able to suck out the resources, savings from the domestically, the private sector will find it difficult. There is a huge crowding out effect will adversely affect the growth process. The second dynamic is that there is also a huge shift from the borrowing side, from the traditional donor to commercial borrowing. Commercial borrowing, whether you borrow from, internationally or locally, it's a huge implications. So that's actually first dynamic. We need to see what's the implication on the growth side. The second side is that if you also look into the decomposition, debt dynamics, it's basically in addition to what actually pandemic and other things driven, it's also there are other factors also equally playing a role. For example, cumulative exchange rate depreciation in this country, which contribute to the debt actually size increasing, and also the growing interest rates and high primary deficit, all being pushing up the debt actually in size. The third one, on the solution side, as the panel member highlighted, we need to look into the actually not only the improving the efficiency of the debt financing, how that investment, the borrowed from the debt is being utilized, whether it's able to get sufficient return to pay back, at least in the medium long run. Thank you very much.
Thank you very much, and good morning to everybody. I just would like to comment on what has been said so far. And my conclusion is that the diagnosis is done. So we know what we need, we know where we are, we know where we rank in all these indicators. We know how much we need to pay the debt. We know how much we need to feed our people, how much we need to employ our population. So why not to do it? And we even know how to do it. We know that we need to build infrastructures because this will enable activities, we create opportunities, this will create multiplying effects. We know that we need to build people, skills, savoir-faire, the know-how, management skills. We know we need to build institutions, stable institutions and reliable institutions. We know that Africa has opportunity, has resources. So how to make this or how to transform this in business, in economic activity, in wealth creation? We need to create wealth in Africa. That's where the government will look for tax to pay the debt, to employ people, to create infrastructure and so forth. But to do that, we need promoters, we need entrepreneurs, we need people that are willing to do the hard work. To have success, we need vision, we need inspiration, but we need hard work. We need to master science and technology. We are talking about digitalization, we're talking about artificial intelligence. This means coding, this means what we call now STEAM, science, technology, engineering, and mathematics. So let's teach our kids, let's raise their interest in science, technology, and mathematics, and this will make a difference. We have to focus on the results, because results is what creates jobs. I'm bankers, I'm from Caixa Econômica. Banks will look for the repayment capacity. The lenders, they will look for the repayment capacity. So if the region, a country, a company is not able to repay, they will not get the fund they need. And we repay with the wealth, with the creation of the wealth, the product, the service to sell and to cover the money we invest to cover.
Thank you, sir.
Thank you.
Give it over there. A mic for stand up so that they know who. Please. Okay.
Merci beaucoup pour ces analyses très pertinentes et ces food for thought. J'ai bel et bien aimé l'analyse en termes de dette domestique et de dette extérieure et surtout de dette pandémique et non pandémique. Dans une perspective de relance post-Covid, est-ce qu'il y a lieu quelle priorité faut-il accorder en termes de traitement de la dette domestique pour améliorer la demande ou donner de l'oxygène aux entreprises qui sont endettées et sur lesquelles on devrait se baser pour créer de la croissance. Et c'est cette même croissance qui est nécessaire pour juguler la dette. Quelle est votre perspective? Je vous remercie. Et juste un autre point, c'est le lien avec le commerce extérieur, notamment le commerce intra-africain, exportation et importation, cette balance commerciale qui est aussi une source de l'endettement. Merci.
If we can move to the part that each of the panelists, answering in 30 seconds the questions that have been raised. Thank you.
It's over to you, Madam Moderator, to distribute the floor to the panelists to respond to the questions. Mr. Braganza, just, yeah, you have 1.5 minutes to respond to one question.
Okay, thank you very much. I'll respond in the following way. And I'm actually excited that Raymond talked about PPPs. I was waiting to hear that in this conversation. If you allow me, I'll present what I consider my own type of PPPs as a way of getting out of this conundrum that we face. And the PPPs are as follows. It's power, policies, and people. Let me start with power, and it talks to Ali's question and many in terms of the comments that have been shared from the panel, from the audience, I beg your pardon. Power is about who makes the rules and who decides how the rules are being implemented. Over the course of this week, we've heard several panelists talk about Africa not being at the table when global rules are being made. And there's a very famous adage that civil society organizations are using. If you're not at the table, you're on the menu. And we're on the menu because we're not making the rules. Let's take the global minimum tax rate, for example. And this is not an attack on the OECD. But
I will defend strongly.
But it's important to see where these rules were made. When we're talking about who should be punished and who should be rewarded, the rules are set by, and as I said, externalized from the continent. We don't have power to make the rules. And in order to do, as the colleague has said, if we know what the problem is and what we need to do, why don't we do it? The question is, where do we derive our power as a continent? Mr. Samba, the businessman who talked a couple of days ago, lambasted us for wearing European clothing and not promoting our own indigenous fashion here this week during this. We derive power from those types of things. And when we derive power in that way, we can start setting the rules. We talked about batteries and other natural resources that are being used to advance technology and high-tech mobile phones, laptops, and so on, are all found on this continent. But yet we are price takers. We're not price makers. Who is dealing with power? I think that's the first thing. The second one is on policies. Okay.
Okay, over to you, Mr. Fall.
Thank you. Yeah, I think the question from Ali is very important, the governance. It's very difficult in a crisis situation to say we're going to punish the government. Actually, if you punish the government, you punish the people behind. So, even if we condemn the behavior of some governments, there are populations behind. And, it's better to look forward and try to build back better so that those things not happen again instead of punishing the government. it's where this discussion on conditionalities comes. I mean, we don't like conditionalities in general, but if the governance was proper, we would not need conditionalities. Countries that have performing governments, they borrow huge amounts and they have non-conditionalities. But when they fail, and Greece is an example, Greece had conditionalities that were tougher than what we went through in the 80s in Africa. And I know them, I grew up in Africa, and I can tell you what Greece went through, we didn't went through. So, you know, the borrowers, the lenders are the lenders. So if you were not serious with the money, at some point, you'll have to respond. Just to also one of the question, I think there are some differences in nature between domestic debt and external debt. The domestic debt often it's non-payment of government bills, while the external debt are borrowings. So that creates a difference in the treatment by governments. Thank you.
Over to you, Mr. Gilpin.
Just very quickly, let me start by adding a little bit to my colleague and disagreeing a little bit. Africa is at the table when the rules are made. Africa has seats on the board of the IMF and on the board of the World Bank. Your representatives sit there and discuss these things. The problem is that African governments articulate these issues outside those boardroom contexts as individual countries. What if we spoke with one voice? 1.2 billion people are saying, we want this, we don't want that. People will be forced to listen. And so that for me is the context. We are at the table, but we do not leverage the power of our collective voice. Secondly, I want to address Ali's free rider problem, that why are we punishing the good and rewarding the bad? I don't think dealing with debt is rewarding the bad for a couple of reasons. One, Africa has a bad neighborhood problem. So if Omicron is in 2 South African countries, the whole of Africa has it. If 2 African countries are underperforming, the credit rating agencies go crazy and downgrade like mad. And so our addressing debt in the poorly performing countries helps correct that perception and helps allow us all to the tide to raise all boats. And the cost of borrowing for the poor countries is a lot higher than the cost of borrowing for the well-performing. So there is some justice there. So it's not just a free rider problem. We don't have any choice. We need to address this debt and development financing issue. Thank you.
Now over to Mrs. Mavis Owuzu Gyamfi online to address
Thank you very much.
the question.
So I just wanted to echo what my colleagues have said around the point around Africa and the African neighborhood challenge. So if we look at some of the opportunities we got around COVID, you know, our ability to speak with a common voice meant that we made some progress, more so than we probably would have made if we had spoken with a single voice. So we should not underestimate the power of our voice. We did not get the levels of vaccine that we wanted, but trust me, if we had gone as individuals, it would have been substantially less than we actually received. So there is some merit around going as a strong voice of 1.2 and rapidly growing market that everybody is looking at. The second point I wanted to make was around leadership, leadership, leadership. You know, at the end of the day, it boils down to our leadership. And the leaders we vote in, the leaders we choose, and what our leaders do for us. And the fact that we are all leaders in the choices that are being made on the continent right now. Leadership matters. And if we're going to navigate our way through this process, we need leaders who will not just be at the table, but who will actively engage at that table. And if they get there and they feel that the seat that they've been given is too short, put some cushions on it and raise it high and get our point of view across and come back home and implement the policies that are needed for us to get out of this crisis.
Thank you. I was showing you the card. So over to you, Madam Moderator, to close this session, please.
Thank you. Thank you very much to all the panelists. It has been really an interesting session. And thank you all for your insight, perspectives, and responses to all the questions, but also to the audience, both virtually and in person, for their active participation in this session. Thank you very much, and enjoy the rest of the day.
Thank you very much. So we're supposed to have the next session right now. So we are going to take 5-minute breaks, and then you come back. And our dear hostess has been working hard to get you back on the room. So facilitate their job, please. Thank you.